Good morning. Thank you for joining today's daily webinar. Today we're going to go over how to combine Backdoor Roth IRA and Mega Backdoor Roth Solo 401k in the same year. That's a good way to really supercharge your Roth funds, whereby the funds end up in a Roth Solo 401k and a Roth IRA. A lot of individuals out there are not aware that you can contribute to both a Roth IRA and a solo 401k. You just have to make sure you have enough earned income to support the contributions. As always, today's daily webinar is for informational purpose, educational purposes. We are not providing investment or tax advice on today's webinar. Please subscribe to our YouTube channel and like today's presentation for more presentations like this. We'll be going live again here in a few hours at 1 p.m. Pacific time as part of our daily 2-day series webinar. Okay, let's get started on how to combine Backdoor Roth IRA and Mega Backdoor Roth Solo 401k funds in the same tax year. Let me go ahead and share my screen here. Okay, so as part of the strategy of doing both the Backdoor Roth conversion and the Mega Backdoor Roth conversion, you would make contributions to both a non-deductible IRA and then to the voluntary after-tax solo 401k. The annual IRA contribution limits for tax year 2025 remain at $7,000. For those age 50 or older, it increases to $8,000. So you would make that $8,000 or $7,000 contribution for tax year 2024 to a non-deductible IRA. Let's say you have a non-deductible IRA at Fidelity. So you would make that $7,000 contribution for tax year 2025 to that non-deductible IRA at Fidelity. Then you would also open a Roth IRA at Fidelity unless you already have one there. And then you would ultimately convert that $7,000 non-deductible IRA contribution to that Roth IRA. Now, an item to keep in mind is that if you have other IRAs, such as simple or SIP IRAs or other traditional IRAs, those IRAs will impact your conversion of those non-deductible IRA funds. So in this example, that's $7,000 to the Roth IRA because of the pro rata rule, which essentially means you're going to have to convert some of those pre-tax funds and some of those non-deductible IRA funds. However, you are able to isolate those non-deductible IRA funds by transferring your simple IRAs or SIP IRAs and other traditional IRAs or gains in that non-deductible IRA. You can transfer those to the solo 401k pre-tax bucket, and that'll isolate those non-deductible IRA funds, and then you can convert those over to the Roth IRA, known as the Backdoor Roth IRA. So that's how it's done from a IRA perspective. From a solo 401k side of things, On top of doing that non-deductible IRA contribution amount of $7,000 that we just went over for tax year 2025, if you're self-employed and have enough net self-employment income from your business, you can contribute the full overall limit of $70,000, known as the 415 limit. That entire $70,000 can be contributed to the voluntary after-tax solo 401k bucket, aka bank or brokerage account, also in the name of the solo 401k, and then you can convert those funds immediately over to the Roth solo 401k designated account, so within the same plan, or you can convert that 70,000 voluntary after-tax solo 401k contribution to a Roth IRA. For example, let's say your self-employed business is an LLC taxed as an S corporation, and for tax year 2025, you report $70,000 of W-2 gross wages from that self-employed LLC taxed as an S corporation. Because the voluntary after-tax solo 401k contribution is a dollar for dollar calculation, you're going to be able to contribute that entire $70,000 as a voluntary after-tax solo 401k contribution for tax year 2025 and immediately convert it to the Roth solo 401k or the Roth IRA. So that's how you end up being able to convert both a non-deductible IRA contribution for tax year 2025 of $7,000 to a Roth IRA, and then the $70,000 of voluntary after-tax solo 401k funds to the Roth solo 401k or the Roth IRA. So in essence, you'll end up with $77,000 in Roth funds at the end of the day. $70,000 of solo 401k funds and $7,000 of IRA funds. So that's a great way to really supercharge your Roth funds by utilizing both the voluntary after-tax solo 401k mega backdoor Roth strategy and then the backdoor Roth IRA strategy. Now let's go over the steps involved in the mega backdoor Roth solo 401k strategy. You share my screen here. So there are 5 steps in the mega backdoor Roth self-directed 401k, aka solo 401k strategy. Before we get to those 5 steps, you first have to open a self-directed solo 401k plan with a provider of solo 401k plans whose plan document allows for the mega backdoor Roth solo 401k strategy. Not all providers allow for it. Companies that do not allow for it are your traditional financial institutions such as T. Rowe Price, Wells Fargo, Chase Bank, even Fidelity and the Schwabs of the world. However, if you utilize a specialized company like My Solo 401k Financial, who offers a self-directed 401k that does allow for the mega backdoor Roth strategy, then once you identify that provider, you then need to open up that self-directed 401k by filling out that provider's online application. That provider will provide the plan documents for your signature. Once you sign them, the plan is considered adopted. So then you can start with the first step in the mega backdoor Roth process, which is to open up the holding account, aka bank account or brokerage account, that's going to be designated as the voluntary after-tax bucket. So you have to segregate each source of solo 401k funds. So that brokerage account will be titled in the name of the solo 401k, and it'll list in parentheses the words voluntary after tax. The second step is you make the contribution into that voluntary after tax account, so brokerage account or bank account in the name of the solo 401k plan. You then, under the third step, move the funds from that voluntary after tax solo 401k brokerage account or bank account over to the Roth solo 401k bank or brokerage account, also titled in the name of the same solo 401k plan. So it's still considered one plan. Or you can convert it to the Roth IRA instead. Then under step 4 is you need to complete the conversion form. So if you use my solo 401k financial for the Mega Backdoor Roth strategy, we will have you complete an online conversion form where we collect the necessary information to report that non-taxable conversion to the IRS, which is step 5, where we issue that Form 1099-R. So it's going to be reportable, but not necessarily taxable, because you want to convert it right away so that there are minimal gains, as just the gains of that conversion will be taxable. So those are the steps involved in the Mega Backdoor Roth strategy. Okay, so those are good items to keep in mind when you're looking to both combine the Backdoor Roth IRA and the Mega Backdoor Roth Solo 401k strategy in the same year. Let's see if we have any questions here. Here's a question here from Justin. Are solo 401k max contributions based on percentage of reported salary for LLC taxes and S Corp? It depends on the contribution type. Let's pull up some information on that so we can talk about it further. With the self-directed solo 401k plan, you are required to have separate holding accounts for the plan to hold each source of funds. That is pre-tax funds, Roth funds, and voluntary after-tax funds. When making contributions to the solo 401k plan, the plan in this instance would be sponsored by the self-employed business, so the limited liability company, taxes and S corporation. So one plan, it allows for all 3 contribution types. If you want to make a pre-tax solo 401k contribution, that can be made as an employee pre-tax solo 401k contribution or as an employer pre-tax solo 401k contribution. If you make it as an employer pre-tax solo 401k contribution, that's going to be a percentage. So if it's an LLC taxes and S corporation, you can contribute 25% of your gross wages from your self-employed LLC taxes and S corporation. For example, if your LLC taxes and S corporation, you pay yourself $100,000 of gross W-2 wages, and you want to make an employer pre-tax contribution, aka a profit sharing contribution, you can contribute 25% of $100,000, so $25,000 as a pre-tax employer contribution. You can also do an employee pre-tax contribution. That one's not percentage based, that's dollar for dollar. So based on that $100,000 example, for tax year 2025, the annual employee contribution limit is $23,500. So you could do a $23,500 employee contribution through that pre-tax bucket. What's interesting is with the Roth solo 401k bucket, you can also, instead of doing employer pre-tax solo 401k contributions, you can do an employer Roth solo 401k contribution, and that would flow into the Roth solo 401k, and that's still going to be a percentage. It's going to be 25%. So in short, employer profit sharing contributions are always based on a 25% rate, whether you make it as a Roth employer contribution or as a pre-tax employer contribution. Now, the voluntary after-tax solo 401k contribution, that one is dollar for dollar, just like employee contributions. So back to the example I used earlier when we were discussing the mega backdoor Roth strategy, for 2025, the overall contribution limit is $70,000. So if you report at least $70,000 of W-2 wages for your LLC taxes and S corporation, you can forego making all these other contribution types and just solely make the voluntary after-tax solo 401k contribution up to $70,000. And that would flow into the voluntary after-tax solo 401k bucket. And then you can convert it to the Roth solo 401k bucket or to a Roth IRA. Okay. Looks like you have a follow-up question here. 25% cumulative, no double dipping between Roth and pre-tax. That's exactly right. If we're talking about an employer profit sharing contribution, and again, an LLC taxes and S corporation, and again, the $100,000 example, the maximum you can do is $25,000 as an employer contribution. You can divvy up that $25,000 employer contribution where you apply some of it as an employer Roth solo 401k contribution and some of it as an employee as an employer pre-tax solo 401k contribution, but you can't go over that amount on the employer level. So 25%, 25,000 is the maximum. All right, looks like we have another question here. I have money in a 401k trust bank accounts, voluntary after tax, and Roth. I will move that money to personal Roth IRA from each. Do I make transfers, then fill out my solo 401k form for each transfer to get my 1099s? Great question. So if you have an existing solo 401k with our company and you made a voluntary after-tax solo 401k contribution, then you can subsequently convert that voluntary after-tax solo 401k contribution to a Roth IRA. You get to choose whether to convert it to the Roth solo 401k or to a Roth IRA. If you convert it to a Roth IRA, you'll want to go to the Forms tab of our website right here on the top right-hand corner of our website. You'll click on Forms. See if I can share my screen here. You're going to click on Forms, and then you're going to scroll down under After Tax to Roth IRA conversion form. You're going to click on that, and here are the steps. Let me put this over here. It'll take you to this online form. So here are the steps. So for the mega backdoor Roth, so you make the contribution to the voluntary after-tax solo 401k bank or brokerage account bucket. You then move the funds to the Roth IRA, which is step 4. And then you come back to step 3 here where you complete the conversion form, which is this form here. This is how we collect the necessary information so that we then issue that Form 1099-R to the IRS. So if you do a conversion this year in 2025, and that means it's going to be reported on a Form 1099-R, which will be issued to the IRS in January, February of 2026. Since the conversion is happening here in 2025. Let's see here. If you make a Roth solo 401k contribution, that typically needs to stay in that Roth solo 401k plan, unless you meet a triggering event. So generally, in order to transfer funds out of a Roth solo 401k, and if we're talking about contributions to the Roth solo 401k, those have different rules than the voluntary after-tax solo 401k contributions. The Roth Solo 401k contribution, you typically cannot transfer that Roth Solo 401k out of the plan, even to a Roth IRA, until you meet a triggering event, typically age 59 and a half, or no longer being self-employed. So keep that in mind. Okay, let's see here. It looks like we might have another question here. Can you expand on tax treatment of after-tax account treatment? First, I've heard of it. Primarily flow through, or what if funds are invested within? So voluntary after-tax solo 401k contributions are not tax deductible. So for instance, when you make a pre-tax employee contribution, you can deduct that on your personal Form 1040 tax return. And if you make a pre-tax employer contribution, that's deducted on your business tax return. Now, if we're talking about after-tax contributions, voluntary after-tax contributions, those also are not deductible. And the purpose of the voluntary after-tax solo 401k contribution, which is part of the Mega Backdoor Roth solo 401k strategy, is to indirectly get more Roth solo 401k funds in your plan. So by utilizing that voluntary after-tax solo 401k contribution, you're going to be able to get all the way up to the $70,000 Roth solo 401k overall contribution limit. Take a look at this page here from our website. Let me send that over to you. I'm going to give you some homework. Take a look at this page here, which goes over the whole Backdoor Roth IRA, Mega Backdoor Roth Solo 401k strategy. It explains it from A through Z. It's got great FAQ questions as well. And then you can come back to tomorrow's daily webinar and pick back up with your questions. So let me share that with you. There it is. Okay. Let me see if I can put it up here on the screen. So take a look at that. That's your homework for tomorrow. Let's see if we have any other questions here. So it looks like another question from Justin. I'm a registered investment advisor. Does your platform integrate with the ability to have advisor manage and bill on your company accounts? So our annual fee can be paid from the client's holding account, so their bank or brokerage account, or it can be paid with business funds or personal funds. So yes, you have the ability to work with the client and paying our annual fee by either the client's holding account or the business bank account or personal account. So yes, our plan does allow for that type of arrangement. Looks like we got a question here from Mark. I am over 60 and made a $7,500 makeup contribution for 2024. After moving money to personal IRA, do I use same form to get my 1099? So if you made a contribution, so yeah, so you have until your business tax return due date plus timely filed extension here in 2025 to make 2024 contributions to your plan. So if you make a contribution here in 2025 for 2024, that's going to count as a 2024 contribution. However, the conversion rules are different from the contribution rules. So don't mix those up. When you convert funds, whether you convert from the voluntary after-tax solo 401k bucket to the Roth solo 401k or the Roth IRA, that's going to count as a conversion occurring in 2025. Therefore, you're not going to get a 1099-R until January, February of next year, 2026. Now, it's not going to impact your tax situation in any fashion at all because, again, you can contribute for 2024 here in 2025. That's a whole separate piece of the puzzle. The conversion piece is another piece. Those conversions are taxed in the year that the funds are actually converting. Well, if you're converting voluntary after-tax solo 401k funds to the Roth IRA or the Roth solo 401k, it's not going to be taxable anyways. So it's not going to impact your taxes. So whether the conversion was processed in 2025 or if it was processed in 2024, it's not going to have any impact. The impact is going to be when the 1099-R gets issued. So in sum, that 1099-R will not get issued until January, February of next year in 2026 if you don't convert the funds until this year in 2025 to the Roth IRA or the Roth Solo 401k. That is, you move the funds from the voluntary after-tax Solo 401k to the Roth IRA or the Roth Solo 401k plan. So it sounds confusing, but that's how it works. Okay. I think, well, one last item there. You mentioned there's $7,500, which is the catch-up contribution. Keep in mind that catch-up contributions can never be deposited to the voluntary after-tax solo 401k bucket. The only funds that can be contributed to the solo 401k voluntary after-tax bucket is the overall limit up to $70,000. So the catch-up amount of $7,500 for tax year 2024, that can only go to the Roth Solo 401k bucket or the pre-tax Solo 401k bucket. That cannot go to the voluntary after-tax Solo 401k bucket. It's another important item to keep in mind. I'm going to assign some homework to you as well, Mark. Let me share this link with you here. You're going to want to look at this link here, the Mega Backdoor. There's a lot of good information there that talks about how you cannot apply a catch-up contribution as a voluntary after-tax contribution. And there's also this chart here does a good example too of explaining whether you should convert to a Roth IRA or the Roth Solo 401k. So take a look at that. All right, we've come to the end of our session here. I've enjoyed our daily webinar today. We'll be back here again today at 1 p.m. Pacific time. Until then, have a great rest of the day.